Hello to our viewers. I'm Jen Kohls of Richardson Capital Management, and I'm joined with Dan Brown, our Director of Investment Management. We are here to provide the economic and investment update for the first quarter of 2026. This past quarter saw major economic shocks. Markets were calm early on. Then in late February, the U.S. and Israel joined a military campaign against Iran. This caused energy prices to soar while other asset classes declined. Dan, would you like to expand on the impact of this war over the past month on the markets?
So it's no surprise that the military campaign led to negative returns in the month of March, both for stocks and bonds. As far as stock performance is concerned, the S&P was down about 9% on the month. We did see other indexes enter correction territory. So correction defined as a fall of 10% or more from a prior high. And as far as markets that underperformed or performed the worst, we saw international developed and emerging market stocks perform the worst, mainly because they're more energy reliant than the U.S. economy is. So I want to remind our readers and listeners that the U.S. economy is actually fairly energy independent. So we are a net exporter of both crude oil and natural gas. So again, the U.S. economy should fare a little bit better. And as far as the spike in energy prices is concerned, so we started the year with U.S. oil at about $57 a barrel, and it spiked to about $104, $105 a barrel late in the month of March, mainly because of the energy disruption of supplies coming out of the Middle East. So all the oil tankers that come out of the Middle East have to pass through the Strait of Hormuz, and as of month end, that is still effectively shut. So a lot of tankers not wanting to traverse that fairly dangerous waterway. So energy prices are probably going to remain high until that waterway is open, which we're hoping is fairly soon. But again, U.S. economy fairly energy independent.
We also saw interest rates go up over the past quarter. The conflict in the Middle East has renewed concerns of higher inflation. Dan, how about you provide an update on the Fed Reserve Board's meeting mid-March for our viewers?
So interest rates did go up in the month of March, mainly because investors are now anticipating that there will be less Federal Reserve interest rate cuts. And there's a very small probability that there's even a Federal Reserve interest rate increase to fight the higher level inflation that'll likely come from the higher energy prices. We wouldn't put a lot of credence on an interest rate increase from the Federal Reserve, but at the Fed's mid-March meeting, they talked about the uncertain economic impacts, from the war. We talked about the higher energy prices that'll likely lead to a little bit bump higher in inflation. We don't think we'll see 2 to 3 rate cuts from the Federal Reserve like we were expecting at the beginning of the year, but we think it's still reasonable to expect 1 to 2 quarter point cuts from the Federal Reserve. Those might be pushed out though, maybe from the second quarter, third quarter to like the third quarter, fourth quarter.
These events have made for alarming headlines and market volatility. Yet those two components are nothing new to the experience of the seasoned investor.
That's right, Jen. We went back and looked historically at different geopolitical events. So the graph that we're showing looks back at 14 historical events starting in 1962 all the way through the current U.S. and Israel attacks. And the message in our takeaway here is that, markets maybe underperform a little bit right before and right after the event, but 1 year and 3 years out, the returns are pretty strong. So we're showing the averages here. 1 year out, stocks up about 10%, 3 years annualized returns up about 12%. So I think the biggest takeaway, and I think the title says it very clearly, is just stay the course amid geopolitical volatility, because we do see some alarming headlines, but we think more so it creates temporary volatility as opposed to permanent damage. So again, at this moment in time, we're not willing to change our discretionary portfolios or our asset allocation. We are doing the best to remain patient. And again, that's the overriding message that we're trying to convey here is just stay patient. The U.S. stock market has been a great place for compounding returns over the years. So we show that if we look back, from 1950 through 2025, U.S. stock market is up about 75% of the time. That's, something we don't want to underestimate or fade.
With all that behind us, Dan, What is our outlook for the financial markets?
Outlook is still constructive, and the biggest thing that we're paying attention to, that we paid attention to for the last really 2 years, is just the outlook for corporate earnings. And as we've talked about numerous times, corporate earnings remain very strong. We haven't seen really any meaningful decline in the outlook for corporate earnings since the start of this military conflict. So we entered the year expecting double-digit earnings growth for the S&P 500. We still think that's in store. We are paying very close attention to this military conflict and the economic fallout. So one thing that could change our positioning is if it goes on for longer, energy prices remain a lot higher, inflation spikes meaningfully. Maybe the Fed has to resort to interest rate increases to combat inflation. That would very likely change our positioning. But for now, staying the course. And I do think it's meaningful to point out that the couple areas that we are strategically underweight are the areas that are underperforming, namely international developed and emerging market stocks.
Thank you for sharing your insights, Dan, and thank you for watching. As always, we appreciate your trust and support.